Hey guys, welcome back to the channel. I'm Michael Studebaker, and today we're going to be discussing why index funds are good, going into more detail about index funds, investing strategy for it, and in everything you need to know. If you haven't already, please subscribe, like the video, hit the notification bell if you want to be notified when content comes out. Now let's get into it. So first off, what is an index fund? Well, an index fund is a type of mutual fund or exchange traded fund, ETF, which is created to track the performance of all the companies in that specific index. These indexes can be measuring the overall market, emerging market, bond market, international market, and so forth. This is tracking the collective performance of all the companies within that index instead of individual stocks, which is tracking the performance of all of that specific company. When you deposit money in and buy into an index fund, you technically own a small portion of all those companies within that index. An advantage when investing in index funds is that for starters, they have very low expense fees. On average, Vanguard's expense fees range from 0.1 to 0.04% annually, which is very low. This is because the manager of that index fund isn't actively analyzing and researching to see which investments to hold. Because of this, index funds are considered passively managed funds as opposed to actively managed funds, which brokerages offer, and as well as individual stock investing, which is done by yourself. Actively managed funds usually consist of a manager or a management team that does research and analyzes, then makes decisions on the best way to invest the investors' money. However, this does involve a much higher expense fee as well as the individual buying and selling fees associated with it. Studies have shown that actively managed funds have been proven to rarely beat the market, which is why index funds are generally a safer bet in the long term. The next thing is that index funds over the long term have been proven to outperform any actively managed funds by over 90% of the time. So if you invest in an index fund, you will have a very good chance of getting a higher long-term return. Another advantage to investing in an index fund is that it is very straightforward and simple in terms of just depositing the minimum amount, or more if you would like, and not having to do any research or look at the price, but rather just buy and forget kind of investment, which is very convenient. This is good, especially if you're working and are busy all day and don't have time to do your own analysis, but you still want to earn a passive income or start your long-term investment journey. Can't forget the main advantage of an index fund, which is the instant diversification it gives to your portfolio once you start investing in it. Owning an index fund means owning a small portion of all the companies within that specific index, giving you a broad ownership of different companies in multiple sectors from tech, healthcare, energy, etc. This means that if one of the companies underperform, it won't impact your portfolio that much as compared to when you invest in individual stocks, which could lead to a bigger loss. But historically, with the economy over time, it has proven to rise in value, hence why this is a good long-term investment choice. As I mentioned in my previous video, one of the books I read when I was learning fundamentals to investing was John C. Bogle's The Boglehead's Guide to Investing. In there, he mentioned that the recommended strategy for index fund investing was the 3-fund portfolio, which consists of investing in an overall total market index fund, an international total market index fund, and lastly, a bond total market index fund. Vanguard has one of the lowest expenses as has been around since 1975 when it was created by John C. Bogle. If you're interested in this strategy, the way to go about this is, for the overall total market index fund, go with the Vanguard Total Stock Market Index Fund, VTSAX for the ticker symbol, which is what it identifies by in the stock market or brokerage. For the International Total Market Index Fund, go with the Vanguard Total International Index Fund, VTIAX, for the ticker symbol. For the Bonds Total Market Index Fund, go with the Vanguard Total Bond Market Index Fund, VBTLX, for the ticker symbol. If you are younger and have a few decades before retirement, I recommend going more aggressive with this strategy. An example of an aggressive approach is a 64% in overall total market index fund, 16% in international total market index fund, and 20% in bond total market index fund. If you're older and closer to retirement, I recommend going with a more safer approach. An example of this is 14% in overall total market index fund, 6% into international total market index fund, and 80% in bonds total market index funds. With this strategy, this allows you to have the instant diversification on your portfolio with very little expense fees. Since this is the 3-fund portfolio strategy, you are diversifying even more as you would be invested in 3 different index funds across 3 separate markets, which would give you a safety net in case any major corrections occur in one of the markets. If you have any questions, my email is there. Feel free to contact me. So I hope you guys enjoyed the video and found it useful. If you did, please subscribe and like the video. Hit the notification bell if you want to see more content like this. I hope that this gave you guys a better understanding of what index funds are and the advantages of investing in them for long-term returns, as well as the strategy for investing in them. The journey towards financial independence isn't easy, but by starting and gaining experience, you'll get there. Consistency is key and hard work pays off. Thank you guys. I'm Michael, and I'll see you guys in the next video.